Hey all, Time Weller here from forexreviews.info, and I hope you're all having a great day. Well, welcome back everyone. Welcome back to part 12 in the Price Action Traders Mindset series. In this video part, we'll be going over a concept in trading which is called exposure. And what this means is it means the amount of risk that you have in the market. So let me give some examples. Let's say you have a number of different trades on the market, and they're either all in negative territory or they're all just before the management process, meaning before they've gone to break even or before they've gone a decent amount in profit, so you can start to lock in your stop loss on those positions. So what this refers to is exposure. It's exposure, meaning that what your account is in risk. And let me give you some examples of how exposure can get out of hand and what I recommend as well. Well, first of all, you want to keep exposure controlled and to a minimum. One of my highest recommendations is to keep your exposure level below 2 and maximum 3 trade signals. In particular, I would highly recommend 2. Now, I'm going to go over why in a moment, but first of all, let's look at the reason why having too much exposure can cause problems for your account. The first one being is, say you have a whole series of trade signals in the market and they all look good. So you have like 5 or 6 signals. Now what tends to happen is if you take all those signals may be correlated in some way. So what ends up happening is you're increasing your exposure on your account, right? And this is simple mathematics, by the way. So if the trades do not go your way and you happen to be wrong, there's a possibility that you can be wrong on all the positions. Now, if you're following good money management, such as 2% per trade signal, which is one of my recommendations, then you would have risked up to, now if you had 6 trades, that would be a 12% loss on your account. If you had 7 trades as another example, like some traders can have 7 trades on their account, that could be 14% loss on your account. Now, there is no, way to protect yourself from exposure other than managing the amount of exposure that you give yourself to the market in the first place. And so this is why I go back to why it's important to control exposure again. If you have just 2 trade signal risks on at a time, right? And let's give a bit of a better rundown. Let's say you see 4 really nice signals in the market, all at the same time. They're all daily signals or they're all 4-hour signals. They're all great signals and they multiple confluences. They're all lining up. They all look great. And you're looking at them going, oh, I want to take all 4 of them. What I recommend doing, instead of taking all 4 of them, look at the concept of exposure in this process, because commonly what we'll be doing is we'll trading currency pairs that are correlated, like I said, so that if you're wrong on one, then you may be wrong on all of them. And so this is why exposure is very, very important. And so let me emphasize this once again. Now you've got the 4 trades that all look good. Now what I recommend is you just pick the 2 that have the best reward, or 2 that you feel the most comfortable with trading, right? So what you're basically doing is you're just looking for the best 2 signals out of those 4, right? And then you want to take your trades on those 2. This makes it so that no matter what, even if you did happen to be wrong, instead of being wrong on all 4 signals, you would only be wrong on all 2 signals. Now, exposure is not a common thing. Like, it's not something that happens all the time. It's not common to have 2 trades beyond the management process, right? And what I mean by this is, how do we get out of this exposure rule? Well, how do we control and how can we manage this? Well, let me just give you an example with my own trading, and so that way you can actually see what I mean by actually limiting your exposure and how you can actually undo that rule as well. So when you've got a trade on and it's beyond that management point and you've taken partial profits off and you're locked in that last position and it's running and the market's trending really well and you're allowing to run and the trade is risk-free, then you do not consider it exposure. Therefore, you could have a myriad of trades on. You could have 4, 5, maybe 6, maybe 7, maybe 8. It's not uncommon for me to have trades on that are on for over a month, right? So this is an example of once a trade is locked in, is protected, is risk-free, has been locked in with your stop loss, etc., based on your management rules, right? Now, this could be management rules that we go over in the recent training that I brought out just a few months ago, which is called the Engulfing Trader series. This is just some examples, right? So what I'm trying to say here is this, right? Once you get to that management period where the trade is risk-free, you don't have to see it as exposure in any way. So you could have, let's look at another example. Say you had 3 trades on, right? One had exposure, meaning that it was either in a little bit of drawdown, like a little bit in minus profit, by the way, that if you're wondering what drawdown means, or it was a little bit, a little bit in profit. Basically put, it wasn't at the management point, it wasn't locked in, it was not risk-free, and the other 2 trades were running, maybe over 100 pips each or 200 pips each, both running quite nicely into the trend, and they were both locked in, they were both managed, and also some of the partials were taken off in those two positions. This means that you only have one exposure position in the market, right? And so you can take another position, you can take another exposure, right? And you're limiting that exposure element of your account. Therefore, you can never ever, under any circumstance, lose more than 4% of your account, right? Even when you're completely wrong on a move, which can happen occasionally. Unfortunately, it just does happen in trading sometimes. Wrong on a trend-based move, whatever it is, it means that you can only take a certain amount of loss. Now, this is an important aspect of money management, and also an important aspect of psychology as well. So it's important to understand as a price action trader, and to develop the price action trader's mindset, to understand that limiting, understanding your exposure amount, how much are you willing to lose, right? Okay, and this is the important key of what I want to go over here as well. When we're looking for signals, when we're looking for trade signals, and we're looking at multiple different pairs, and we are seeing multiple trade signals in the market condition, we tend to focus and we tend to see pairs that correlate to one another, right? And this is not wrong. There's nothing wrong with that. It's just that tends to happen in the market. And that's why I was saying that if you have a high exposure, like say 6 or more trades or 5 or more trades, then you're really pushing the limit of how much you could potentially lose if you're just wrong once, right? And that wrong once could be a 10% loss. Okay, so limiting exposure, following the process, keeping your trades, keeping your account to a certain methodology. And this goes back to many other practical tips in psychology as well. How much can you handle losing per trade? Not only that, how much can you handle winning? Many traders feel conflicted about how much they can handle winning as well when it comes to trading. So, and they have trouble holding. Okay, now this is an aspect of reducing exposure as well, because once you've locked in that trade and break even, you're letting that other trade run, letting it run to at least the next opposing structure point, or at least to a next opposing reason to exit the market, right? But our emphasis is we want to let that second position run as long as the market is indicating to let it run. That way, when we get a nice trending move, it can build our account exceptionally. Okay, and that's high probability trading there. That's an extra little tip. It's a little bit different to exposure. Exposure, you've got to understand, exposure is just the amount that your account is taking risk at a time. All right, so if you've got 2 trades, they're both in the minus, then they're not necessarily lost trades, but your account risk potential is 4%, right? If you're risking 2% per trade signal. Now, you may be only risking 1% per trade signal, and that's a completely different ballgame. That's a lot more lower risk, and I highly recommend some people that if they have trouble with risk less. It's okay. And some people have a really high risk tolerance, and I went over this in a previous video as well, where some traders don't mind risking 5 to 10% per trade. But let me tell you, those sort of traders always, and I emphasize this because I've spent time with a lot of traders that are high income earning traders. Those traders always tend to blow their account eventually in the end, unfortunately. And so that's why I'm emphasizing on good risk management, good money management, keeping your risk low, keeping your exposure low, right? And then that way you've got the ability to fight another day. Now, if, in example, say you got those 4 signals again, going back to the emphasis of the 4 signals, and you took the 2 that looked the best, or the 2 that had the best reward, 2 that had the best price action, and you managed those trades. And as soon as those trades got to break even, or to a management level where you took off some partial positions and the trades were risk-free, or one of them was risk-free, then you can start to look at those other 2 that you were looking at before and just seeing if maybe those positions, those structure levels, or those points where the trade was existing, is it still in that zone? Is it still a viable trade to take another trade on that other signal, because now you've only got one exposure, to add an extra exposure to your account? And so anyway, that's just a little bit of a tip for the day. A little bit of a tip on exposure. I highly recommend keeping it below 2. Okay, 2 is a good exposure rule. Some traders prefer to only keep 1, and I understand that as well. They only want to lose 1. They only want to lose that 2% of their account. And when once that a trade is risk-free or managed, then they can move on to another trade. And that's a very easy way of keeping it simple, keeping your trading very, very low risk. Okay, because a lot of traders fall into this negative habit, this bad habit of trying to extend their account. They think that the more trades they take, the more profit they're going to make. Okay, and it's not necessarily the case. The more trades you take, the more risk you're taking. Because a lot of the time, when you're looking at currency pairs, and especially a multitude of currency pairs, you're seeing correlations everywhere. And those correlations think that you've got 4 or 5 separate signals that are all good, but if they're all correlated in some way, that means that if you're wrong on one, you could be wrong on all of them. And that's a big tip to just think of. However, if you take one and then the trade goes your way, gets locked in and break even, everything's going good, or you take 2 and they all work and your trade process is locked in, risk-free, etc., etc., with your money management, right, with the management process of those trades, then of course you can go look at other trades and jump in, because you've got no exposure once you're risk-free. There's a difference between exposure and a risk-free trade. Okay, and until the trade is risk-free, or is locked in, or is taking partial profits on and the other trade is locked in, or etc., etc., such as some of the stuff that we go over in the Engulfing Trader series, which is a series that I brought out in early December. Now, if you haven't gotten access to that, I highly recommend jumping over to my site at www.forexreviews.info and finding out all about the Engulfing Trader series. And you can find out all about it. It goes over a whole lot of different key elements into high probability trading. Okay, so overall, my tip for the day, and this is a really, really big tip, is once again money management based. Keep your exposure low, keep your risk levels low, keep your trading safe, keep it profitable, and I'll see you in the next video.